What's going on, guys? It's Kyle here, and today we're going to actually break down a property. We're going to go into my office, we're going to pull up a deal, and we're going to analyze it. Now, I've got to preface this whole video by saying I am terrible at this. I've always been the type of guy that likes to just kind of shoot from the hip, as they say. I'm not super analytical. I'm not a real good numbers guy. But by doing this video, I'm also forcing myself to try to learn more and more. So when I analyze a property, a lot of times I'm doing rough math on a piece of paper and with a pencil. Not super in depth, and somehow real estate's very forgiving, and I usually end up doing just fine. But we are going to dive into the calculator that I've been using for quite a while now. It's pretty easy, it's really basic. Again, I'm no pro. I'm not analyzing 10-year projections into the future or anything like that. We're gonna keep this property really simple and make this really easy. So hopefully this adds some sort of value to you guys. And if you guys enjoy the video, I would appreciate if you hit the like button, subscribe, and maybe commented on the video. It helps the channel grow. So anyways, guys, thanks for watching and hope you guys enjoy. All right, guys, here we are. Let's quickly do an analysis on this property right here. So I've recorded this now twice. The first time I failed at a couple things, had to redo it. The second time I recorded to 20 minutes and I'm like, this is way too long. So I'm going to cut out a bunch of stuff. We're going to keep this extremely basic and just fly through this. So I'm on Zillow right now and I found a 2-bedroom, 2-bath duplex. I'm going to show you how I would do a quick and dirty analysis on this. I'm not a pro at this. Oh boy. My wife is sending me office text messages. Let's really quick silence my notifications. Oops, that was the wrong button. Okay, maybe this one's gonna be 20 minutes too, but okay, here we are. So there's the duplex. We're in St. Louis, Missouri. Let's read about it really quick. So it's an investment property, well priced, attractive, and well maintained. It's a 2-family with a newer roof, windows, and water heater, and kitchen upgrades. Current tenant rent is $560. Tenant pays all utilities, including sewer and water. And the market rent in the second unit is approximately $600. I know a little insider knowledge on this property or where it's located. I actually owned a place right up the street from it. And I know that this realtor, whoever said it's approximately $600, I know that it's actually much higher than that. So we'll keep that in mind. Here's a few pictures. It's all brick. It looks very well maintained. It really looks like we don't have to do anything to this property. It's pretty much move-in ready. So we'll also keep that in mind as we're running our numbers. So I love the fact that it's all brick on the outside. The roof is, probably good for another 10 plus years. Just easy to maintain. So let's jump over to my calculator that I like to use. And you guys have maybe seen me use this calculator before. It's not mine. It's just one that someone sent me. And really think of it, it's analyzing the current numbers, and then the market numbers are what you think it should be. So think of this spreadsheet kind of split down the middle here, current and market. But the first thing we're going to fill out up here is the unit count. And, depending upon if you have 1-bedroom, 2-bedroom, 3-bedroom units, you type that in differently. But I'm showing I have 1 unit. They're both 1-bedrooms, but 1 unit at $600 and 1 unit at $550 on the current right here, not the market, but the current. So we'll fill out the market data in a little bit. Moving down, we're showing a 5% vacancy loss. That's just an average that I like to show. So you'll see, here's unit 1's gross revenue. Here's unit 2's gross revenue. Subtracting the vacancy and loss. So that gives us a gross income of $13,224. So let's move down and start filling out some more of the expenses. So admin, we don't have any of that. Advertising, we're going to use Facebook Marketplace. It's free. Contract services, that'd be things like pest control, other things that you're going to pay like a year for, and some type of service. So we're not going to pay for that. Insurance, call your insurance agent, give him the rough idea of what the building is like, and he'll say, hey, I think it's maybe about $900. I know that my building up the street was about $900 and it's about identical. So we're going to leave it at $900. Property management. Actually I self-manage, so technically I wouldn't have to put anything in here, but let's say you're paying a property manager, and right now I'm showing that you're paying 8% of that gross number there. So that's $1,057 per year in property management. Real estate taxes, very easy. Find out what county you're in, call the assessor, or actually better yet, go on Google, type in tax records, St. Louis County. All you gotta do is type in the address and it'll tell you what they're paying in property taxes. However, that's not necessarily what you're going to pay because it's going to be reevaluated when you purchase the property at that new purchase price. So just call the assessor and be like, "Hey, I'm buying this property for $110,000. What's the taxes going to be?" And he'll tell you. So type that number in there. Repairs and maintenance. This number is going to be something you're going to learn. The more you do, I'm showing that I'm going to do 8% of the gross income. That's going to go towards the repairs and maintenance. Now, repairs and maintenance are things like leaky faucets, like a door's not closing. Maybe there's a hole in the drywall that you're patching. It's just little stuff that you're going to be repairing on an annual basis. So I'm putting 8%. Depending upon if the property was old and falling apart, I would probably do more like 10, 12%. If the property was brand new, I would do like 3%, 5% or something like that. Salaries and payroll, we don't have that. Utilities, in this box, you can either add up all the utilities or you can break them out separately here. And again, if you remember on the Zillow listing, it showed that the tenant was paying all utilities. So we don't have to pay any utilities, which is fantastic. Lawn care, I called up a lawn care company and they said, "Hey, in this area, we mow roughly 25 to 30 times per year. And I think I figured it's going to cost $40 per time." And they'll tell you, send them the address, they'll look at it, they'll say, "Hey, it's going to cost $40 to mow this." So 40 times whatever number I chose. I think, I think I divided it. It was like 27 times I estimated that we were going to mow. So that equaled $945. Snow removal, I think I threw in 7 times per year. Obviously, it's going to depend upon where you are in the country. Okay, so all these expenses added up equals $6,117 per year. And then moving down, we have the net operating income. So that is the gross income subtracting all these expenses equals $7,107. Now, here's just some details. We'll jump into that in a hot second, but we're going to jump over to the top right. And this is something I probably should have filled out first. And this is the information on the purchase price, the closing costs, the down payment, all that stuff. So as you can see, this property sold for $108,000. So that's what we're going to type in there. And then as far as the down payment goes, that number is figured on this box right here, the loan to value. So how much does your bank require you to put down? My bank requires me to put 20% down. So that means that it's going to be an 80% LTV, which means the down payment's going to be $21,600. And then the closing costs, that's something that you could call your lender and get a more or just more detailed number on what it's actually going to be. But I like to use the rule of thumb, when I'm first starting out on my numbers, that it's going to be roughly 3% of the purchase price. So I just took 3% of 108, and that's 3,240. So that's going to be all the little bank fees, your appraisal, and all that stuff just to get the thing closed. Okay, this box right here is CapEx. Now, CapEx is the big stuff that you're going to be fixing, like the roof. Maybe you need water heaters, you need new AC units, maybe you need new floors. And it's the big stuff. It's not the small repairs. Now, this property, as you saw in the pictures, is turnkey. It's great shape. It's move-in ready. So we don't need any big chunk of capital day one. So we're going to leave that blank. My bank told me the interest rate's going to be at 4.3%, and we're going to amortize it for 25 years, meaning the length of the loan is going to be 25 years. So the cash that we need at closing is this number right here, $24,840. So let's go back down to the bottom of the spreadsheet and look at what we got. So the operating expense ratio is just something that you're going to find, the more you analyze deals, you're going to find out that there's kind of rules of thumb or averages. And this is pretty accurate because I know that multifamily property operate around a 50% expense ratio. That means that, if you receive $100,000 in a year, $50,000 or 50% is going to go straight back out to expenses. So this 46%, it seems pretty accurate. If I saw that number at like a 25% or 30%, I'd be like, something's wrong here. I forgot some expenses. A cap rate, if you don't know what that is, just look it up. I know it's a way to judge how much you're purchasing a property in a sense. It's a long story, but long story short, I know that a 6.6 cap is I'm probably overpaying a little bit for this property where it sits. So it just gives me an idea, roughly what I'm paying for the area. Now the CapEx reserve, remember I showed you this number up here that's the CapEx that we need the day of closing. However, we know, even though that roof is relatively new, we know in 10 years from now, we're going to have to replace it. So this little yellow box over here is the number, it's the CapEx reserve, that is per unit. So I'm going to say that $200 per unit, we're going to set aside in maybe a separate account or just earmark it for those big expenses like replacing the roof or the water heaters or whatever. So $400 a year is going to save up into, those big expenses or for those big expenses. Yearly mortgage payments, that's just pulling that information up from the top down. And then, so this number right here is going to be your net cash flow. So all said and done, after all your expenses, you're going to make $1,029, which honestly, it's not super attractive. Your debt service coverage ratio is something that your bank is going to look at, and they want to see generally somewhere around a 1.2, and this is a little bit low. It's 1.18 or 1.18, and so that's a little bit low. And then the cash on cash return. So your cash on cash return is the return on the money that you actually have to fork out. So it's looking at what is your return on that $24,840 that you had to put into the property. And it looks like you're getting roughly a 4% return, and that is not fantastic. So that 4% return, although it's not fantastic, would I purchase the property? I might, because I might know some insider knowledge. And that's why we're going to go up here and we're going to fill out the market, what I actually think it's going to be. So I know this market and it's appreciating. There's a lot of stuff going on in that area. And I'm going to go ahead and tell you that it's going to rent for about $700 per unit. So automatically it went from $13,224 to $15,960. So let's fill out these expenses really quick. So the insurance is going to be the same. The property management, let's just, let's see. So property management, that times 8%. And if you're self-managing, take that number out. It's going to be, all the better. Real estate taxes are going to be the same, 876. And then repairs and maintenance, let's do that times 8% again. Okay, and then lawn care would be the same. Snow removal would be the same. Okay, so we updated the expenses, and now let's look at our numbers. Now we're seeing, a better return. We're at 13%, 13% cash on cash. And, these numbers, again, they're just very broad. They're not going to be perfect, never going to be perfect. You have no clue what kind of repairs you're going to have to make. But this just gives you an idea of how I begin underwriting my deals. I will openly admit I am not good at the numbers. I try to be. But the thing is with real estate, it's very forgiving over time. As long as you don't buy it in a way overpriced, eventually you're going to make your money back. So this deal wouldn't be horrible if I knew that I could increase my rents to, the $700 per unit. That's the thing that you want to know. I may, again, buy this for a 4% cash on cash return as long as I knew that, hey, values in the area are appreciating like crazy, or if I knew I could up, the rents to $700, or maybe I knew that if I invested, some capital in the building up front, it would really force some appreciation in the building. So hopefully I didn't forget anything too important. just a quick and dirty way of analyzing a deal. Again, I'm no pro. You should probably do way more research and practice yourself. But appreciate you guys watching this, and hopefully it helped. All right, if you guys are still around, I appreciate you guys watching the full video. I know that got kind of long, but hope that helped some way, kind of give you a better understanding of how running numbers works. Again, I'm no pro at this. I do it quite often, but not to a super in-depth extent. I keep it pretty basic. So if you guys have any more detailed questions, drop them in the comments below. Otherwise, thanks for watching, and we'll talk to you in the next one.